Hello, ladies and gentlemen. We are students from RPI's Quantitative Finance and Risk Analytics program. Our campus advisor is Professor Edwin Singh, and our CQA advisor is Mr. Patel. Hello, I'm Haochen Liu, the Chief Investment Officer in this team. I'm responsible for overall strategy and ensuring efficiency in all the functions. I also focus on the technical analysis for the investment.
Hello, my name is Yongqian Lu, and I'm the portfolio manager of the team, and I'm responsible for the portfolio allocation and optimization.
Hello everyone, my name is Gautam, and I'm the quantitative researcher in the team, and I'm responsible for regression analysis and choosing the stocks.
Hello everyone, my name is Jyotsna Haritsa, and I'm the fundamental analyst of the group. I'm responsible for researching the different industries, tabulating the best performing and worst performing stocks, and helping in stock selection depending on various factors such as earnings, current stock performance, and market.
Hello, my name is Minghan Zhu. I'm the risk manager of the team. I'm responsible for managing risk and tracking data and other performance indicators of our portfolio.
I would like to introduce one more member of our team, Patrick, who couldn't be here today. He's our industrial analyst. He is responsible for the industry analysis in the strategy building part and the attribution analysis in the performance analysis part. First of all, I will offer an introduction to our whole report. There are two parts in our report. The first part is about the methods we use to build up our strategy. And the second part is about the performance of our portfolio. There are two steps to build up a good performance portfolio. Firstly, we should decide which stocks to buy and which to short. And secondly, how much we should buy or sell. For the first step, we pick up a set of optional financial indicators reflecting the situation of a company and some industry indicators as fundamental analysis. And then regress to find out the most excellent combination of indicators from all possible options. After that, we use a set of logically combined technical indicators as a filter to decide the final stock pool. As for how much we should buy or sell, we build up an optimization model with constraints to find out the most beneficial weights for each stock. In the performance analysis part, we use a bunch of ratios such as Sharpe ratio, Treynor ratio, and Jensen index, and some other indicators describe the portfolio performance as a whole. Then we go into the portfolio and apply the attribution analysis to describe the performance of our portfolio in each sector. Now we will talk about those methods in details.
For our portfolio, we decided to use this concept of sector rotations based on the differences between the market cycle and the financial cycle. The financial cycle tends to delay or tends to lag the market cycle, so the market tends to anticipate the financial cycle if they think that some of these indicators would lead certain parts of the economic sectors to do better than others. Some of the basic sectors that do well in different parts of the financial cycle, during the expansion periods, you'll see technology sectors, basic materials, and energy sectors do well. The idea behind this is, people are willing to pay some of the premiums of technology. I would also put in here healthcare in the early expansion areas. Again, those are some sectors that generally hold higher premiums and people are willing to pay them in order to be equity holders. However, when we hit recessions, you'll see utilities, financials, and consumer cyclicals. Some of the theories that we came up with for the reasons why, the fundamental theories why, is, utilities being gas companies and water companies, they generally have low multiples. People if they're going to invest, they're not going to put their money in banks they're going to tend to put them in utilities. They're not going anywhere, they have low valuation multiples, and so people, if they're going to put their money in something, it's going to be utilities. At the end of the recession, you'll see pickups in consumer cyclicals. It seems like whichever one follows the other, but consumer cyclicals, if people are willing to invest in consumer cyclicals, then that means that the recession is over. If people feel confident enough to take part in that. Financials as well, you can think of on a fundamental basis, if people are going to put their money in banks, right, how do you measure the value of a company, or especially a bank? If they have more cash, they should have higher multiples. So if you see more people putting their money in banks because of the recessionary period, then you'll see that these prices should go up on a fundamental basis because with more cash, they have more money to invest in other areas.
Now I'm going to talk about the regression part in our presentation. We based our regression on the Pharma-French three-factor model, and the basic equation for the model is shown here. And the parameters are: RA is the return of the asset, RM is the return of the market, RF is the risk-free rate of return, and alpha is the intercept from the regression, and E is the standard error for the regression. And SMB stands for small minus big, which is used to measure additional return from the stocks of companies with relatively small market capitalization. And HML stands for high minus low. This has been constructed to measure the value premium. And along with these variables, a pool of various fundamental data points are considered to be dependent variables. And these are earnings per share, price, gross margins, operating margins, return on equity, etc. And the strategy for the selection of variables is we carried out regression across various combinations of these dependent variables on the return, and the R-square scores calculated from these regressions are compared, and the regression with the highest R-square score is chosen as a basic equation. And after doing this, the highest R-square score is obtained from regressing these 7 variables. They are dividend yield, dividend growth, and gross margins, operating margins, and price to earnings ratio trailing 12 months. And after calculating the equation, after arriving at the equation, beta is determined for all the stocks, and using the regression equation along with the current data, expected return is calculated, and based on these returns we decided which stocks to go long and which to go short.
For technical analysis, we use trend indicators such as MACD, cost indicators such as moving average, and overbought, oversold indicators such as KDJ to build up a system for picking proper stocks. A stock with a good future should have an upward trend in the long run and is undervalued in the short term, vice versa. Now I will give an example of technical analysis of a stock we trade, CIE. For the long run, we focus on the monthly data. As we can see from the graph, the 5 months, 10 months, and 20 months moving average are moving downward, and the shorter term moving average is below the longer term moving average. At the same time, the MACD is below 0 and the DIF is falling. So the long-term downward trend hasn't been reversed. For the short term, we look at the daily data. The KDJ indicators is at a very high level, and a down cross has just happened. So the stocks has been overbought in the short term and it is moving back. At the same time, the price has continuously grown sharply for 3 days with its volume shrink at the end, which means the bullish investors are losing their buying power. As a result, we shorted this stock on November 6 and made over 70% return so far. We applied this technical analysis to all the stocks picked by our fundamental analysis and decide the final stocks pool as an input to the optimization process. Now, my teammates will talk about our optimization methods in details.
It's time for me to talk about the optimization part. Our objective function has three parts. The first part is the risk-adjusted return, which is the Sharpe ratio. The second part is the absolute return, and the third part is the transaction cost. In our equation, ER is the 1/n metric of the expected returns of the underlying stocks. W is the n/1 matrix of the stock rates. In our model, each stock has two weights, one for the long position and the other for the short position. Therefore, the weight of each stock is the weight of the long position minus the weight of the short position. And capital V is the variance covariance matrix of the underlying stocks. A and B is a constant. Since the final score of the competition consisted of 40% of the risk-adjusted return rank and 20% of the absolute return rank, we set the parameter of the risk-adjusted return rank, which is A, to 2, and the parameter of the absolute return, which is B, to 1. TC is the 1/n matrix of the transaction cost. We assume that the transaction cost for every stock is fixed, and this part not only takes into consideration the transaction cost, which makes our model more practical, but also avoid the situations that both the long and short positions in one stock is positive. When it comes to the constraints, first we set both the weight of the long position and the weight of the short position to 0 and 25%. The reason why the weight of the stock cannot be more than 25% is that in the stock trend platform, we cannot invest one single stock with the weight more than 25%. Also, this strategy can help us diversify the risk of the portfolio. And for the cash, since the cash cannot be more than 5% of the unlevered portfolio value, the sum of the long position weight should be between 95% and 100%. Also, the sum of the short position weight should be equal or lower than 100%. For the Donner-Neutral strategy, the sum of the long position weight minus the sum of the short position weight should be between -0.05 to +0.05. Also, for the beta-neutral strategy, the weighted average of the beta of the market risk, of course for the market risk, is between -0.2 to +0.2.
Okay, now we are going to talk about portfolio returns. Until February 23rd, absolute return rate of our portfolio is 38.81%, ranking first among 32 teams. Sharpe ratio is 2.55, which ranks fourth among 32 teams. And alpha of our portfolio is 36.21%, which ranks first among 32 teams. And beta of our portfolio is 0.03, which is very close to 0 because we use beta-neutral strategy. Now we are going to portfolio benchmark. A benchmark of our portfolio is Russell 2000 because stocks we pitch in our portfolio are almost middle and small cap stocks. We can see this from this chart. And our portfolio performs much better than Russell 2000. We can see our portfolio performance and Russell 2000 performance in this graph. Now we are going to the return analysis. As we can see from this chart, 5 stocks has very huge positive returns in the last 4 months, which all exceed 50%. They are SUNE, WLL, CRE, EGN, and PBYI. So this can explain why our portfolio has a very high absolute returns. Also, most stocks we pitched is 15 out of 27 have positive return, and 12 stocks have negative returns, which are fewer than those with positive return. Also, their absolute values of return rate are much less than those positive returns. That is why we have a portfolio with a very high absolute return. And the returns of 5 stocks account for about 111 return for the whole portfolio. They are SUNE, WLL, EGN, PBYI, and SCTY. And WLL and EGN are from basic material sector. SUNE and SCTY are from technology sector, and PBYI are from healthcare sector. So that is why return of our portfolio most comes from these 2 sectors. They are basic material, technology, and healthcare sector. And there are little few sectors with negative returns.
When we look at the attribution analysis of our portfolio, we see that there's a heavy weighting on financials, nearly or over 50%. The idea here was, with the bull market for several years and interest rates remaining so low, we believed that interest rates would increase and that would incentivize people to put their money into banks, naturally increasing the value of the company. However, some of the companies that we were invested in, that wasn't the case. What did happen though with some of the financial companies, we were invested in REITs, and due to the high dividend yields, people flocked to those in light of the bear market over the past couple of months, causing them to drive the value of our portfolio. Some of the other positions, just generalities, we were long in industrial goods, financials, and consumer goods. We were short technology, healthcare, and basic materials. This goes along the lines of what we believed about sector rotations, especially with technology and healthcare. During expansionary periods, we believed that technology and healthcare deserve the high premiums, the high valuations, based on what they could do, their cash flow, and their willingness to hold on to debt. A lot of the technology companies, they generally are earnings negative, and yet they'll still have high valuations on a sales multiple basis. Healthcare as well. These are very risky areas, but people are willing to pay the valuations there. Basic materials as well, with oil, here with the oversupply of OPEC not willing to reduce their production rates, caused a lot of the refineries, a lot of the oil producing companies to struggle, and therefore benefited our short position in our portfolio.
Thank you for watching.